I just want to welcome everyone here today to another monthly installment of Harpanowicz's monthly investment update videos. Joining me here today is Jordan Stewart, Portfolio Manager and Market Strategist at Federated Hermes, frequent on CNBC and Bloomberg. Happy to have you here with us, Jordan.
Thanks for having me, Trey.
Yeah. Just wanted to get started with a pretty basic, lay of the land. Inflation's cooling and interest rates are falling. Discussion more about interest rates falling in the future. Can you just kind of give us a 1,000-foot view of, where you think the market sits here today?
Yeah. Since 2022, kind of post-COVID world, as we started to emerge from that, we saw kind of a bifurcation in the economy. One being, late 22, this, Microsoft CEO comes on 60 Minutes and does an interview talking about AI. And you saw this, very narrow, large mega cap companies emerge and create this enormous and growing and again narrow focused economy that bucked the trend. The rest of the economy, the rest of the world saw this declining rates, less inflation, slowing, less hiring, and a lot of the market, a lot of the economy has been kind of stuck in this malaise. Starting to come out of that, but there's been this kind of 2.5, 3 year period where small amount of companies, and the big ones, we know them, Microsoft and Google and Facebook, have created this economy within an economy that is enormous and growing and exciting and will expand into the rest of the economy. But that part of the economy has kind of held up the market and has caused some consternation from the Fed. Hey, look at this fast growing space. Look at all this money being invested. Meanwhile, the rest of the economy is kind of been going sideways. So there's this bifurcation that we see, which could create an opportunity for the have-nots, if you will, versus the haves.
Yeah, exactly. That feeds perfectly into my next question, the Magnificent Seven, right? It's been leading us for quite some time now. AI-driven, a lot of people discussing, the circularity of it all and the possibility of a bubble, right? I mean, 1999, 60% of the market was led by a handful of stocks, right? And then the 10 years after that, they all lagged by about 4% or more. Do you see that happening again, or?
I do. There's a lot of similarities, right? In 1998, the internet was going to be real. But who wins, we don't know. Right now, AI is real. It's going to be a huge productivity boom in multiple industries, but where and when is the big question. Who are the winners? Who's, pets.com, books.com or amazon.com in 1998. We didn't know who the winners were going to be probably for 10 more years. Similarly today, you're kind of building that infrastructure up. You're building these massive data centers that need to be powered and cooled and have infrastructure around them. And these tools that right now are just kind of fun, like late 90s. The internet was just kind of fun to, click around and find websites and maybe do a little bit of shopping, but not a lot. Now AI with ChatGPT and all these other offerings, it's yet to be seen. Now the market is discounting perfection. These companies are expensive relative to the market. They're not as expensive as they were in the late 90s. Is there a bubble building? I don't know, but is there a rational exuberance potentially building? Possibly. Now let's see what happens this time around. The market's learned from the excesses of the late 90s. We haven't seen an IPO bubble like we saw in the late 90s. We haven't seen these emerging .coms that we saw. That's yet to be seen. And these companies have a ton of free cash flow, great balance sheets, good business models. So they're doing well in that sense, but there's definitely a lot of concentration, right? There's a lot of companies, a lot of investors are focused on those 6, 7, 8 companies. Meanwhile, the rest of the economy, like I said, is good, not great. But the market's kind of priced in that differential.
Yeah. You mentioned the IPO market there briefly. We've definitely seen a resurgence from last year from the IPO market. What's your expectations for 2026?
Yeah, so 26 should be much better than 25, but there's been a clear recovery. So let's go back to the bubble. 2021, there was 350 U.S. IPOs. If you add the SPACs, so special purpose acquisition company, So companies that had no assets, but were, had an intent to kind of buy a company, bring them public. There were 700 IPOs in 2021. So that bubble popped. 22, there were 75 IPOs. 23, 100. 24, 125, and then last year 150. This year we're 183. So just I think a healthy recovery, not a bubble. Good companies that are going public. A lot of companies that are profitable, and I think that that should give some credence to broadening out of the market when there's more opportunities. Hey, I want to have AI exposure. I want some capex on AI data centers. Well, there's only been a couple companies that are available today. Now these new companies, fresh companies, faster growing companies going public, that should lead to kind of a broadening out in the market with new IPOs coming to market. And I'd say broadly, it's not just AI companies. It's across the board. There's healthcare companies. There's been aerospace companies, a couple of fintech companies, even space as an industry. Up in the stars. There's been 2 or 3 companies that have gone public, not SpaceX yet. So it's pretty exciting and broad based and very healthy recovery. Again, 183 as of last Friday, according to public sources.
Great. Going to the thought of different sectors, more sectors becoming, the IPO market or broadening out there from an overall equity perspective, where do you see more opportunities from a sector perspective?
Yeah. So I go to the, like we said, tech has been hot. Everybody wants tech. Everybody wants AI. And so what's been left out has been healthcare. Healthcare the last 2 years had its worst performance relative to the market ever. Specifically, if I were to kind of carve back within healthcare, biotechs. Biotechs still 40% below their highs in 2021. And around 20% of small cap biotechs trade below cash. So cash on their balance sheet is worth more than where their equity value is today. That's pretty wild to us. Now, what that does, that sets up a really good opportunity, right? So again, healthcare and biotechs, they don't do well in a higher rate environment. Okay, so that's been discounted, that's been priced in the performance. Now rates are coming down. Healthcare is a little bit more defensive than the AI trade. Healthcare can also use AI. We think objectively in adding some value in producing drugs and helping doctors to analyze patients, increase throughput, all sorts of things that they can benefit from. But it's been discounted the last couple of years. So we think healthcare, specifically biotech, poised to benefit from the rate change in the market. And then, at the end of the day, these companies have to produce, right? So as biotech companies come out, in the FDA process, they show efficacy in their drug, they show safety. These stocks, they don't go up, 15, 20%. They go up 200, 300, 400%. So that discount creates a tremendous opportunity for areas, but those companies, they have to execute.
Switching gears a little bit to style, small caps did really well in the third quarter.
Yep.
Do we think that trend's going to continue into the rest of 2025 and into 2026, or what do you see from a mid, small, large perspective?
Yeah, so going into the third quarter, small caps were trading at the largest discount ever versus large caps. Small caps versus large caps. And it makes sense, right? Small caps since 22 have been in an earnings recession. They've had almost negative earnings growth every quarter, every other quarter since 2022 quasi-recession. Large cap, the opposite, right? These AI companies have been able to carry the bag, and they've done a great job of accelerating earnings growth. I mean, NVIDIA's, just seems to beat expectations every single quarter over quarter. What happens is law of large numbers, slow down the large caps, and then small caps just fundamentally should start to turn, and you're going to start to see earnings growth for small caps beat large caps, hopefully by 2026. And then that discount that's been factored in should help small caps start to catch up. Not only catch up, but then potentially trade at a premium. And let's just look at this historically, right? So small caps are your historically, growthier companies. They are the new innovators. They're the new AI companies, the new chip makers, the healthcare innovators. So they would trade at a premium to large cap. Large cap companies, they're too big to grow. They can't innovate as fast as smaller cap companies. That's been reversed the last 10 years, where the biggest companies in the world almost like an oxymoron, that large cap growth, like large cap companies typically can't grow faster than small cap companies because they're too big. That's been flipped on its head. We think that reverts back to the mean at some point. Again, just, law of large numbers, 4 trillion to get to 6 trillion market cap is just going to be more and more difficult. Meanwhile, these smaller cap companies innovating, creating, penetrating new markets, they can grow at 30, 40, 50%, into, billions of dollars of market cap rather than these trillion-dollar companies. So we think small caps can catch up here. The discounts kind of priced in all the bad news, and then you start to see a little bit of good news, and these things take off.
Makes a lot of sense. Switching a little bit to the Fed, right? All eyes have been on the Fed for quite some time now. Rate expectations for December and into 2026.
So obviously there's a lot of politics this time around as it relates to rates, but like I said, a lot of the economy is slowing. Employment picture is good, not great. So it's debatable how many cuts the Fed are going to implement. As the president's kind of pushed a little bit on the scale here, they've created a difficulty for the Fed to try to remain its independence. But as you look into 26, the market's pricing in kind of 4 more cuts. So if I count 1 in September, another one by the end of the year, that's 6 cuts in the next 12 months that could be priced in the market. Who's that going to benefit? Small cap companies with debt, companies that have struggled the last couple of years, have outside financing. That should broaden out this market. And I do think the Fed's, I think they're seeing the data, they're reactive, they're hesitant to seem political, but the data is definitely trending in that direction. Housing, especially owner's equivalent rent has come down, which is going to impact housing prices. You've seen oil prices and energy come down significantly. And then, other goods are going to be choppy, but that is decelerating in the right direction to justify the Fed continuing to cut. And what happens very quickly is the market, if I may, it's 2 cuts this year, potentially 4 next year. Then the market starts looking forward to 27. Is there 2 more after that? So now you're pricing in not just 6 cuts, but 8, and maybe 10. And then where does it stop? We don't know. But I think that's a really healthy environment for stocks.
You mentioned a slowdown. Do you see it more as a measured slowdown or, setting us up for further growth? Or do you see it as, a large pullback on the horizon?
Yeah, I think it's a healthy slowdown after, kind of this inflation response after COVID. And it was a weird, this was a business cycle that we've never seen before, right? A quick recession with a lockdown. And then it bounced back in the market up 30 or 40% in a 6-month period. We've never seen that before, right? And then the recovery, based on state by state in the United States and then overseas, and then this big inflation jump due to supply chain issues and all sorts of other things and monetary enabling. It's been very difficult to kind of streamline that. So I do think things have settled, and now you are seeing a healthy deceleration in prices, and the Fed, kind of has a unique opportunity to potentially get ahead of that slowdown before it does get too bad. Now other things could happen between now and then, but I do think the fundamentals are very good globally to maintain kind of a low growth rate, with declining prices, which could set up for some support by lower rates from central banks.
Perfect. Lastly, if you could just leave our clients one key message for 2026, what would that be?
I think the concentration of the market in mega caps, and that performance run is slowly coming to an end. Small caps, cheapest ever versus large caps. Earnings growth in small caps will outpace large caps into next year. And then sectors within that, such as healthcare and biotech, are due for a catch-up trade. Helped by rates, helped by mergers and acquisitions, helped by some of the fundamentals. There's a catch-up trade that's coming where small caps are going to snap back into large caps, and I want them to get ahead of that. But too often than not, we've seen this before, they chase the performance, and once small caps do snap back, it's a 30, 40, 50% move historically, then clients start to come in. So I want them to try to get ahead of that trade. The mega cap trade, again, doesn't mean those stocks are going down, going to zero. It just means the small caps are finally going to catch up and get their day in the sun.
Perfect. Jordan, appreciate your time.
Thanks,
Thank you.
Trey.